Let's understand two important models used to measure default correlation in a very simple way. First, we have reduced form models, also known as hazard rate models. These models assume that the probability of default of a company depends on overall economic conditions like interest rates, inflation, or GDP growth. In simple terms, companies are connected through the economy. We can write the hazard rate as lambda of I at time t equals base rate plus sensitivity multiplied by a macroeconomic factor. Now think of an example. Suppose two companies operate in the same economy. If there is a recession, both companies will face financial stress. Their probability of default increases at the same time, which creates default correlation. So, they may default around the same period. The main advantage of reduced form models is that they are simple and capture real-world economic trends. However, the level of default correlation is limited. It is unlikely that two companies will always default together just because of economic factors. A good way to remember this is, companies default together because the economy affects them. Now let's move to structural models, also called firm value models. These are based on the idea that a company defaults when its asset value falls below its debt. The default condition can be written as asset value at time t is less than debt. In these models, default correlation is introduced by linking the asset values of different companies. If one company's asset value falls, the others may also fall, especially if they are in the same industry. For example, imagine two companies in the real estate sector. If property prices crash, both companies will see a fall in their asset values. This increases the chance that both will default, leading to high default correlation. The advantage of structural models is that they are flexible and can model very high levels of correlation. However, they are more complex and require detailed data, which is not always easy to obtain. To remember this easily, companies default together because their financial health moves together.